So welcome to another video in our Introductory Investments course videos. Today we're going to be looking at the world of technical analysis. Um, by the end of this presentation, you'll understand the purpose of technical analysis, some of the key concepts such as price trends and some indicators. We'll also look at some real-life examples as we go through. Now, technical analysis, although it might not be the perfect tool for telling you when to buy or sell certain stocks, although certainly people use it that way, one of the nice things about the information in this chapter, I think, is it gives us some metrics to try to measure what's actually going on in the marketplace and or in a particular stock as far as where the prices seem to be going, etc. So our objective today is understand technical analysis, looking at the tools. We'll look at things called moving averages. We'll look at different types of charts that we can review. And we'll look at pricing patterns and talk about trading volume and how this all relates to a picture of the inner workings, I guess, or the process of trading in securities. In the second half of the chapter, we're going to look at some other indicators of market activity and investor sentiment. We're going to use something called the moving average convergent divergence. We'll see what that's all about and assess the overall usefulness of technical analysis. So you should gain some foundational skills for understanding stock price movements. Technical analysis focuses on analyzing historical price and volume data to forecast future price movements. It's widely used in financial markets, particularly for short-term trading decisions. And while some investors rely purely on fundamentals, they may use technical analysis to optimize entry and exit points. Despite debates about its usefulness, technical analysis remains popular among traders, mostly because of the way it reviews behavioral patterns. Remember that the psychology of market participants plays a crucial role in price information. So an excellent example of this is what they refer to as the GameStop short squeeze in 2021. This is where the price was elevated due to investor trades and then eventually bursting and having some huge losses for some investors. So this is a vivid display of collective investor behavior. At its core, technical analysis is about understanding supply and demand. Instead of analyzing companies' financials, technical analysis focuses on prices and volume. Now, a surge in demand typically drives prices higher, while increased supply exerts downward pressure. Technical analysis predates fundamental analysis and relies on charting historical data. While the markets are considered efficient to some extent, investor psychology introduces inefficiencies. During periods of panic selling or euphoric buying, technical patterns often emerge and they can guide traders. So if markets are highly efficient, then technical analysis wouldn't earn any profits. It exists, so it must be out there. We do know, and we'll talk a little bit about market efficiency in this class, but not a lot, that prices do follow information. But we, as investors, we are the ones that set the demand curve. So we're the ones that set prices. There is a theory that's called the Dow theory. It looks at market movements that can be predicted by trends in the Dow Jones Industrial Average and the Dow Jones Technical Average. Primary trend, a bear, a bull, and a bear market that lasts anywhere from 1 year to up to several years. Secondary trends, a short-term move in the market often runs contrary to the primary trend, and that can last from 3 weeks to 3 months. There are tertiary trends. This is a very short-term stock market trend that reflects minor price moves. If the Dow Jones Industrial and Transportation Average diverge from each other, that newer trend indicates a change in the other. So let's see how we can review this. So we can graph some price trends. There's a 50-day moving average. Quite simply, you take the last 50 days and you find the average price. Tomorrow, you'll drop 1 day. Now you have another 50 days, calculate the average. What that does is helps to smooth out the curve. So if you look here, this is Tesla. The green is Tesla. You can see how varied and volatile that the prices seem to be. But now let's look at the 50-day trend. The 50-day trend is the dashed line here, right? The dashed line here. You notice it's a lot smoother. It follows it, but it is much smoother. The 200-day is the black line. That's down here a little bit further. That's even smoother. So what we can do is technical analysts, and really I think this is the art, if you will, of choosing the technical analysis, is creating what they refer to as resistance lines and support lines. If it goes above the resistance line, that is an indication that you might want to buy. If it goes below the support line, you may want to sell. Setting these lines turns out to be the secret sauce in trying to understand how technical analysis really works. Again, coming back to our example, just to give us a little bit more definition here. The resistance line, that tracks the top selling prices. The support line is the bottom selling prices. When the stock price hits either of these, it could indicate a change. So again, the resistance line marks price ceilings where selling pressure might arise. Right? If it goes above that, you might want to sell. If the support lies below the floor, again, that's where buying typically occurs. So when we talk about something about a breakout is when the resistance and the support lines have created this channel, and now we've gone above. So again, if we go above the resistance line, that indicates a bull market. And if we go below the support line, that might indicate a bear market. And I will say that this technical analysis is somewhat foreign, sometimes counterintuitive the way we think, the way prices and markets typically work. Technical analysis exists, so people must be able to make money by using it in some way.